This is King World News. I'm Eric King, and you're about to hear from London whistleblower and metals trader Andrew Maguire. Be sure to go to our homepage, where on Sunday we are going to have a special audio release covering the gold and silver sector and much more. But without any further delay, here is Andrew Maguire. Joining us now is whistleblower out of London, metals trader Andrew Maguire. Andrew, an update today is so important for people around the world because here we are in summer, and they pulled back gold, silver for 3 straight days after gold was attempting to go up and through 1,300, that key level of 1,300 to 1,310. What's really happening behind the scenes here?
Yeah, Eric, nice to be with you again, of course. Do you remember in February, I warned of a heightened risk of a gold price reset? Now, obviously, a lot of people are wondering what's happening to that. And if you recall, that was based upon the all-important physical markets in a process of sucking out liquidity from the increasingly illiquid paper markets. And then back then, I estimated we were looking at a timeline of as little as 3 to 6 months. Well, Eric, I'm absolutely sure we are on track for a significant price appreciation, leading to an inevitable price reset before the 6-month August timeline runs out. So I know I'm putting myself on the spot, but all I'm allowed to say at this point is watch out in 26 days from today. And that's the King World News exclusive. Let's look exactly where we are. Now, don't be fooled by the officially driven counterintuitive gold and silver action this week. And as you say, Eric, it was all about defense of the round number, and a breach of that would set off a tsunami of sideline buying, and not from flushable synthetic naked long hot money either. Now, obviously it's the physical buyers that would be very sensitive to a cross of 1,300. Now, the officials who rig this market are far more constrained than they ever were, as real fundamentals close this jaw of a vice on their paper market scam. Dips from here, from this point on, will continue to be shallow. Well, actually, we noted that last time, and they have been shallow. I mean, look, it always looks like drama when we come down 20 or 30 bucks. I mean, why? Because the paper market sometimes gets ahead of the physical market for a short period of time. And, so these dips are going to be shallow because those seeking to accumulate physical gold are gaming the paper market to a point that it simply cannot be leveraged anymore. Now, when officials generate sufficient undeliverable paper gold supply in the futures markets to swamp paper market non-delivery buying, and remember, we're talking pure synthetic here, and that, as we saw that this week into the 1,300 level on Tuesday and Wednesday, it appears to work. And that little has really changed with respect to the decades-old wash-and-rinse cycle gaming. However, as we've noted many times, Eric, competing sovereigns, central banks, and institutional physical buyers have learned to capitalize on these divergent buy windows to accumulate large size into a desperate Fed trying to balance gold capping defense. The very obvious single-day addition of 26,323 lots of fresh GC open interest, and that's of gold futures open interest, on Tuesday, just in the August contract, that was 82 tons of undeliverable paper gold in one day. Now, that addition, and of course that was as gold moved to breach the 1,300 level, it indicates these footprints related to official capping, which, and remember, at that time, actually, the dollar was weak. We had bonds being bid. We had JPY strength. We had the crosses. I mean, generally, the crosses were positive into this selling. And it really just consisted of a large tranche of conjured up, undeliverable paper supply to cap gold from triggering very large commercial short stops above the round number. Now, such a move, when it does happen, and it will, after a little consolidation, will drive sovereign bids to stair-step above 1,300, which would lock out very large commercial short cover. Now, hence, the heavy bets being placed to weigh on gold to try and avert that on this occasion. Now, Eric, to put things into context, let's just step back and look at the trail. From the April $1,297 highs through into the May 9th $1,215 lows, now that's quite a big drop, at no time had the massive commercial over-the-counter options sweet spot, to bear in mind that these options are in the $1 trillion area, At no point had they dipped lower than 1260, went all the way down to 1215. So we were absolutely certain that spot gold would not close below this level at the May 31st Bank of International Settlements related options expiry, which is the over-the-counter market expiry. And that's exactly where it closed. And notably, in silver, the optimum settlement point was $17.2, $70.20. That's exactly where it settled at COMEX May expiry. Surprise, surprise. Now, why are these levels important now? Because paper market gaming aside, there is a physical side to these synthetically driven markets. Now, any dips below these two levels force officials and commercials to hedge and short cover because physical buying is just far too strong. Now, sure, we get overshoots, which are the fault of the hot money playing in the officially sanctioned rigged casino they call the COMEX, as alternative physically backed exchanges suck liquidity out of the paper markets. Real hedgers and investors will be far less vulnerable to the sort of games witnessed this week. Now, margin traders are the sole reason we evidence unnecessary intra-month volatility, and this is because their positions are visible to the bankers who, with fake hedges, and that's paper COMEX short positions being backed by paper over-the-counter fractionally held 500 to 1 long positions, and they're 500 to 1 if you add in derivatives.
Andrew, it's really outrageous criminal behavior, but people get conditioned to seeing it over and over again.
They simply use this naked short supply to target the margined accounts of the very clients they hold the book on. Now, this outrageous behavior when you think about it, but we know we've become used to it. We get desensitized to the fact that these market-making bullion banks actually aggressively attack their own clients. Now, when we get overshoots, it requires sufficient hot money margined accounts to rinse for short cover. Now, however, there comes a point where these margined accounts are actually unwittingly underpinned by real physical buying. And this is why on each wash and rinse cycle since January, we're seeing the gap between the physical market support and the paper market close a little more each time. Eric, we've reached a point where it's become impossible for central bankers to overcome physical demand being demanded outside the London legacy system. And as spot gold gets bought in London, and of course it's part of the 600 tons of paper gold that get cleared every day in London, but then it's tendered by certain buyers for delivery in places like Dubai, Hong Kong, Singapore, etc. This backwashes into London, tightening supply even further. And this comes in right in under the radar because, as I say, this is part of a 600 ton per day paper market that clears. But the audacity is that some people are buying it to lock in a price and then seeking to convert that to physical. Now, that's as close to alchemy as it gets. Now, everyone's talking about silver, and silver futures tell a story. They are deeply backwardated to spot silver. Now, the SIN7, that's the July contract, has been trading in permanent backwardation to spot for 9 solid weeks. Not a single day has it been in contango. This SIN7 contract goes off the board this month. Today, spot is averaging a 4.85 cent premium to July futures. Now, these levels of backwardations, as we now approach contract expiry, continue to telegraph an oversold physical condition into what is a very short-term, technically overbought condition. Now, with wholesale support not wavering at $17.20, commercials will be short covering into hot money rinses just as they did last month. Silver is grossly undervalued here. So really what we saw this week was no more than this naked long hot money moving a little too fast above sovereign-sized physical support, which in turn allowed officials to step in before the all-important 1300 resistance was breached and became support. And that, of course, as we said, would lock out any chance of short cover. As I say, Eric, this is really all it's been about. And this week's action is short-term noise ahead of FOMC next Wednesday. Is there anything unusual about this? No. We always see this sort of official action ahead of a big release like non-farm payrolls or FOMC. And let's face it, this June rate hike's already baked in. I mean, they've backed themselves into a corner, and we fully expect there to be a rate hike simply, but we don't expect there to be an awful lot to follow. Now, after this rate hike on Wednesday, this very short-term technical overbought condition will be fully worked off, and physical support will quickly stair-step above 1,300, as it did, if you remember. The fight for 1,200 was very similar to what we're seeing with the fight for 1,300 now. Same kind of gaming going on. And then finally, when 1,200 was overcome, it locked out commercial short cover, and it really forced a major issue. And it forced the, as we saw in the Bank of International Settlements, options expiry was up at 1,260 where the sweet spot was. So we're seeing a stair-step higher. But purely, however, if we know ahead of Wednesday, expect a fight, but I, along with sovereign buyers, see this as an opportunity to add some discounted buys. Now, the open interest structure has already significantly improved, and a big chunk of what was added into Tuesday and Wednesday is already being rinsed back out again. So further dips will evidence more commercial short covering and strong Asian buying and Indian restocking, which we are, over the last 2 days, have witnessed.
Andrew, we'll come back to your interview in just a minute, but first I want to take a moment to talk to you about some gentlemen that are huge winners in the mining business and are quickly becoming legends for their ability to discover gold and put together incredibly successful companies. They founded Asanko Gold in Africa, then Caden Resources, which used to sponsor King World News. Myself and the KWN listeners that invested in Caden Resources made a fortune as the company was acquired by Sean Boyd's Agnico Eagle. These guys now have a company that they believe is the most exciting company ever in terms of the projects that they have put together. The stock has been red hot in a struggling market because everyone thinks that this company is also going to be acquired by a major company. Goldcorp has already made a huge investment in the company, and I'm sure this will turn out as well, if not better, than Caden. The company I'm talking about is Orin Resources, symbol AUG in Canada and GGTCF in the U.S. If you were a serious investor who isn't shaken by the noise in the gold and silver markets and wants to be an investor in this great company, call Jay Adelar at 778-729-0600 or email info@aurinresources.com. That's info@AURYNresources.com. Now back to the interview. Andrew, in closing, let me ask you this. When you look at this summer that's in front of us still as we kick it off, or in really the first couple of weeks here of June, is this going to be the kind of summer that gets rowdy on the upside and shocks people? From what you're saying, it is.
Absolutely, Eric. This is a time I would be very, very, very cautious if you're short gold. This is a time, I'm absolutely certain that this is a time to be actually moving long gold. And I don't get into paper gold. Start picking up some physical, buy some physical, get in there, and I think you're going to see, as I say, watch out in 26 days. And we're going to see some significant moves, and I really do expect that there's sufficient velocity going to be coming through in the physical market to swamp these paper market sellers. And I think what I would do is that if I was anybody out there, I'd make sure I had my physical positions ahead of August at the very least.
Andrew, we know the powers that be monitor all critical conversations and things. And so, the fact that this order is coming means they know this order is coming as well. Do you think they'll put a smash on the metals ahead of that?
Well, I think that we already have some levels. So, as I say, we've gone through this process where the sovereign central bank, competing sovereign central bank buying, there reaches a point where the lines don't cross favorably. Yes, there's been a lot of hot money open interest that has been added, that has been highly vulnerable because it's completely naked long. And we've seen the commercials building up short positions against that in a concentrated form. So we usually see that. But when you reach the point where there is insufficient hot money or that equation doesn't cross very well when you start to move into where the physical levels are. And as I said, the clue really was where Bank of International Settlements is one of the biggest options expiries of the month, and that was on the 31st of May. And the fact that 1260, was a sweet spot suggests strongly that is now, apart from what we're seeing in the wholesale market, suggests strongly that any move sub 1260 is going to see massive short covering from these same officials who are exposed to the physical market. And bearing in mind, we're talking about a massive centrally banked rehypothecated position. Oh, goodness me! And people who don't who call you out on those kind of claims only have to refer back to the 2013 request by Germany for their measly 300 tons of gold that was going to take 2,500 and something days to return, when we can put 25 tons of silver on a plane to India on a single day. And that is ludicrous. So, I mean, it really does, the empirical evidence is there that the rehypothecated positions, these positions are so rehypothecated, there is no central bank gold to offset this kind of buying.
In closing, Andrew, what do you want to say to people around the world here?
I'd say just tune out the 5-minute bar charts on the paper-driven markets. Concentrate on aggregating a physical position. You cannot be wrong in the medium to longer term. We're just talking about some minor moves. The only people that throw their hands up in despair are those heavily margined traders who really are the problem.
Whistleblower out of London, metals trader Andrew Maguire. Thank you for joining us on King World News.
Eric, it's been a real pleasure to be with you again.
Be sure to tune in on Sundays. KWN will have a special release covering the gold sector and much more. And be sure to tune in each day as we will continue to release interviews with the top people in the world throughout the week. Also, make sure to check out the King World News blog.